Well, thanks for everyone for coming tonight. I have a special place in my heart for California, especially as it relates to my research. And let me explain why. I showed up at Chicago in 2005, and my co-author that I work a lot with came into my office and said, you know, I've been reading this research out of the Fed saying that we don't really think that people are borrowing really aggressively against their homes and consuming. We said, you know, that doesn't really pass the smell test. You know, we should look into this. So we basically wrote two papers. We had never worked on housing before then, actually. And we wrote two papers. The first basically said the expansion of mortgage credit to low credit quality borrowers was simply unprecedented. And we wrote this paper in about 2007, just as things were starting to turn. And the second paper said, well, you know, this expansion in credit is actually pushing up house prices, and indeed, people are borrowing and spending very heavily against that increase in home equity. So we presented this research at Chicago. And to be frank, people weren't that sympathetic to the idea in real time. You know, economists have a hard time believing that people would perceive their home value as this wealth that they should really borrow heavily against. So feeling a little bit discouraged, I went to another university out here in Northern California to present, another prestigious one. I won't say the name of which one it is. And I'm presenting this research in front of this audience, and everyone's nodding and smiling. I mean, this is not the kind of reaction you usually get in an academic seminar. And I kind of realized right away that Californians understood this. They were living it. They saw it firsthand in real time. So, of course, that's exactly what I'm expecting tonight, is a lot of nodding, a lot of smiling. Everything you're saying is correct. So let me show you a picture to kind of make this point. I'm showing you basically the housing cycle and the spending cycle from 2002 to 2009. And I'm splitting it out using state-level data, California versus the rest of the country. California is in red. As you can see from the picture on the left, I'm plotting house prices. Everything's indexed to 2003 to make it very easy to interpret, so everything's kind of a percentage change relative to that. And you can kind of see the tremendous relative boom in house prices in California versus the rest of the country, okay? And then you can see the tremendous crash. Okay, that's probably well known to all of you, especially that live here and lived here during this time. What may not be as well known is the picture on the right, where I'm showing you spending, okay? And it's based on sales tax receipt data. You see a very similar pattern, right? So that's something I think people don't appreciate enough, and that is that spending during the boom even was really being driven to a large degree by home equity, okay? And then you can see that the crash was much more severe once we get into the Great Recession. So this is the basis of a lot of the research I've done in the past, research that's been discussed at pretty high policy levels on trying to make the point that one of the reasons the recession was so bad was precisely because levered homeowners had these dramatic declines in house prices and cut consumption massively. So this isn't about the past. We want to look forward, but that's a useful preview. And so what I want to focus on here is very recent evidence that housing may be becoming the bright spot for the macroeconomy. And I want to take a look forward and think about what that means going forward. From a macroeconomic perspective, one of the interesting things is that residential investment is the best predictor of where GDP is going. Of all the components of GDP, residential investment, both on the up and down side, is the best predictor. So even if you have no interest in housing in particular, it's a nice variable to watch in terms of where we're going as an economy. And a lot of forecasters I highlight too here, Bill Dudley, the president of the New York Fed, and Jan Hatzius at Goldman Sachs, have been pointing to housing as a very optimistic sign for where the US economy is going. So the question I'm going to try to take on today is, do we really think housing is going to actually drive an economic recovery in the US? And I'll have some words about maybe Europe at the very end. So let me just show you the kind of hope, okay? You can see it's once, oftentimes if you read the Wall Street Journal, they'll just show you this picture. They won't show you back here. They'll just show you right here, right? And I say, wow, look at the recovery. It's amazing, right? So, so you can see that, in fairness, though, there is a pretty nice spike up there in 2012, not putting us anywhere near where we were in terms of construction. That's what the picture on the left is. And you see the same thing in house prices. That's what I want to focus on. So I don't like to leave audiences, on the edge of their seats. I'm going to give you the answer right up front, and then I'll go through the evidence. Housing was a main driver of economic activity prior to the recession. That's something I've shown in research. I don't have to probably prove it to you, those of you who live here in California, okay? And despite the nascent recovery, my view is that housing will not drive economic activity as substantially as it did, even in the longer term, okay? And I'll talk about the two reasons why as we go through. So let's talk a little bit about why we think housing would affect economic activity. It's not so obvious. There's two main channels that economists generally emphasize. One is residential investment. That one is a bit more obvious. Just directly, when house prices go up, that induces home builders to build more homes. That directly contributes to GDP. That's a form of investment, and obviously it employs construction workers who build those homes. But the second, and I think the one that ultimately could be much bigger, is what is called traditionally the housing wealth effect. It's the idea that when your home value goes up, you feel richer and are therefore willing to spend. Now, the housing wealth effect is a bit strange from an economics perspective because housing is a consumption good as well as an asset. So if your house value goes up, implicitly so has your cost of living. Think about if you were a renter. So it's not obvious you should feel a lot richer just because your home value went up, right? Think about the 30-year-old who's living in Palo Alto right now that rents. Certainly, he doesn't feel richer when house prices go up in Palo Alto, right? So the misnomer comes because it is there. There are a certain group of people that do borrow very aggressively against their homes, but they are a particular type of borrower, what I will call a constrained borrower. These tend to be people who are very low credit score, have very high credit card utilization rates. They behave as if they have very high discount rates that they really need to spend today. Now, we've been thinking about why they do this. It could be that they're liquidity constrained. They actually do have good earnings in the future, and they need to borrow against those, and they need housing collateral to get it. Obviously, another explanation would be a behavioral bias, some kind of myopia, and not understanding the consequences of their behavior. But the big point I want to make is that, the people who actually borrow very aggressively against their home tend to be these lower credit quality individuals. So here I'm showing you basically for a $1 increase in home equity, how many cents against that $1 do I borrow? This is during the boom from 2002 to 2006. And so let me just explain it by looking at the picture on the bar on the left. Okay? The bar on the left shows you that for people with very low credit scores, let's say a Vantage score of 600, they borrowed very aggressively. We're talking 40 cents against every dollar. Okay? Whereas people who with very high credit scores actually didn't borrow much at all. Okay? So that's, of course, looking in the past, but why is that relevant? Because what's happening today? What's happening today is that credit standards in the mortgage industry are as tight as they have ever been. And my argument is that these people that were borrowing so aggressively are no longer, first of all, a lot of them aren't homeowners anymore, right? They've defaulted, foreclosed, they're now renting. Secondly, even if they're homeowners, they can't get a mortgage. Okay? And so let me just show you that by showing you this picture from Lender Processing Services, which is showing you the average credit score of individuals that are getting new mortgages. This is either backed by the GSEs, Freddie Mac and Fannie Mae, private sector, or FHA, and you can see that all three of these lines are kind of sharply increasing. So what that's telling you is that the average credit score of a successful applicant for a mortgage, whether it be a purchase mortgage or a refinancing mortgage, that successful applicant has a much higher credit score today than they did 7 or 8 years ago. Okay? So if you want to put these two pictures together, what it tells you is that the only people that actually can even borrow against their home equity are precisely the people that aren't likely to borrow against it to consume. Okay? So that to me suggests a very mitigated wealth effect. It's not going to be the same as it was before. Let me show you some evidence that backs up that point. In this picture, I'm showing you the fraction of all refinancings that were cash out. What does that mean? It's just a clever term for when people refinance their mortgage and in that refinancing process actually take equity out of their home. So they walk away with cash at the closing of the refinancing. Okay? As you can see, this is basically a lot of our previous research. You can see that the levels of cash-out refinancing were frankly absurd during the housing boom, okay? This is just showing you what I said before. Housing's really driving economic activity. But look what's happening very recently. Just an absolute collapse, right? Even below the level before the housing boom. And I want to make sure everyone appreciates the fact that interest rates are at all-time lows, right? House prices have started to rise again, and despite those two things, people are not taking money out of their homes anymore. Okay? Now that could be both because it's very hard to get a cash-out refi. Anyone, I imagine there's half the audience at least has refied their place in the last year. Those of you who are homeowners, right? It's very hard there's a lot more strict requirements if you decide to take cash out. So it's coming from the credit side, but it's also, I would argue, a compositional issue. That the kinds of people that can actually successfully refinance are the kinds of people that are not going to borrow aggressively against their homes. This is one of the most stunning pictures, I think, that's underappreciated in terms of what's happening in the recovery, and also evidence that this home equity channel is kind of dead. I'm showing you retail spending, again, indexed to 2006, so you can kind of very easily interpret it as a percentage change at any given point in time. And I'm showing you the red line, which is spending on furniture, home improvement, and appliances. This is for the entire country. And the black line is other retail spending. And it's pretty startling that in 2012, a full 5 years after the recession started, spending on furniture, home appliances, and electronics is still 10% below its 2006 level. Okay? Now, why is that relevant? Because survey evidence from the Fed shows pretty strongly that when people take money out of their homes, this is what they spend it on. They redo their kitchens, they buy TVs, they buy furniture, and this is basically just showing you that that's just not happening to a degree that's as strong as it was before. Okay? In contrast, if you look at other components of spending, you're seeing a reasonable recovery. Go ahead and skip that slide. So the basic point here is that there does seem to be a mitigated housing wealth effect. The borrowers that are most likely to spend out of housing wealth no longer have access to mortgage. Many are now renters, and here's the kind of painful irony. Renters actually, when house prices go up, are actually made worse off, right? Because eventually, when house prices go up, rents have to go up. And if you're not an owner, then of course you don't get any benefit. You only have to pay the higher rent. And if it's these same people that have the highest marginal propensity to consume out of income and wealth, these are the same people now that switched from being homeowners to renters. You could make the argument that house price increases were actually a negative for household spending, right? I wouldn't go that far to the extreme, but it's an argument worth considering. So the bottom line here is that I would advise not to expect a debt-fueled spending boom like we saw before the Great Recession. We shouldn't think of the current housing recovery as inducing the same kind of behavior as what we saw prior to the Great Recession. So the second main point I want to raise, which I'm a little bit less certain of in terms of how it's going to affect the housing market, but especially out here in California, is something that you almost have to know if you follow housing markets, and that is the rise of the investor. So investor purchases of single-family homes are at all-time highs, really unprecedented levels, and something we've never seen in this country for at least 30 or 40 years. Okay? So for example, in Los Angeles, the amount of the fraction of purchases by investors has gone from, say, 5% to almost 40% from 2006 relative to today. Okay? So it's a little bit hard to know what that means, but there is a claim out there that I think is reasonable that an investor-driven housing recovery is less likely to have knock-on benefits for the economy. Why? First of all, investors are less likely to sustain price increases. They're going to be much more sensitive, but when prices get too high, they're going to be out of these markets. There's a lot of evidence that that's happened in Phoenix. Phoenix, for example, had year-over-year price growth almost 20% in January and February, and the data take a little while to come in, but the anecdotes are that investors have left Phoenix, right, because now prices are simply too high. Further, there's an argument that people are less likely to engage in home improvement if it's an investor-owned property relative to a homeowner, right? An investor is going to be willing to accept a higher depreciated washing machine and refrigerator. So again, you see this argument that you're not going to see nearly as strong a recovery. Let me just show you one picture that is a little scary, actually, but if you look at the correlation between house price growth over the last year with the fraction of homes in a city that were purchased by investors, it's a small sample. It's hard data to get. It's like very recent. It's only 16 cities, but you do see a positive correlation. So what does that mean? It means that in cities where investors are buying a lot of properties are exactly the cities you're seeing the strongest house price growth. Now, who knows which direction the causality goes here, right? It could be investors driving up house prices, probably my preferred interpretation, but it could also just be investors responding, trying to get in to make some cash. But this is a bit worrisome if it really is all the stuff you're hearing about Case-Shiller index going up, and if it's really just investors bidding up house prices that were previously really depressed because of foreclosures. That isn't the kind of robust housing recovery we think can really drive economic activity. Which really brings me to my final point, and this is definitely more broadly related to my research agenda that I've been pursuing, and that is, we need to really think carefully about what happened in the housing boom, and we need to think carefully about whether we would ever even want to return to that kind of pattern, okay? So again, my argument is that housing really drove household spending throughout the country, especially in areas like California, but even throughout the country. Our estimates are that homeowners pulled $1.25 trillion of equity out of their homes during the housing boom. Who knows if they consumed all of that, but that's a big number. So it starts to dawn on me that maybe the real aberration is not the current weakness of the economy. The real aberration is what happened from 2002 to 2006, and it's kind of a very long hangover. Okay, so let me show you some evidence on that, and then I'll conclude. Here I'm showing you retail sales for the whole country. This is U.S. retail sales data. The red line is the one to focus on. The black dots represent the trend line in retail sales if you use data prior to 2006. Okay, so if we were to have continued on our same path, we would be here. Okay, so you can see the recession very clearly, right? But the thing that's more interesting to me is the recent data, right? Most macroeconomic models of cycles would say that you should see some catch-up. We should eventually catch back up to trend, right? We're not seeing that. It's pretty clear as of 2012, that looks like a pretty permanent gap. I don't know, maybe you squint, you see something? I don't know. I don't see any movement back towards those black dots. Okay? So that to me suggests that there is something fundamental here that's changed about household spending patterns. Here's another way of looking at it. So I did the California versus the other country. Let me be a bit more general. Let me show you spending data for states that were in the, I'm going to split up the country into two groups. The first group, the black line, that's going to be states that did not experience a housing crash from 06 to 09, okay? The red line is going to be states like California, Nevada, Florida, Arizona. They're kind of the four that always get placed together, that had a very bad housing crash. And I'm showing you the pattern in household spending even through 2012, okay? And what do you see? You see something that to me is quite worrisome, right, in terms of that there's something really fundamental, that it's not just a cyclical phenomenon, and that is that, is that you see a reasonably robust recovery in the areas that avoided the housing boom and bust. But you're not really seeing any recovery, a substantial recovery in states that had a big housing boom. And it's this gap that's a bit worrisome, right? Because that gap, again, most models of macroeconomic fluctuations would say the areas that get hit the hardest should come back the strongest, right? That's not happening this time, okay? So again, it suggests that something was special or a bit strange about the pre-period before the recession rather than what's going on now. So let me just conclude with this following thought. And this is a topic of a book my co-author and I are working on. We aren't going back, nor should we. This kind of model of debt-fueled, collateral-based household spending is just completely unsustainable. And it's actually really horrible for the macroeconomy. To have the lowest net worth individuals in the economy taking levered equity positions in idiosyncratic risk on houses is, hopefully everyone that went to Booth, or back then it was Chicago GSB for most of you, hopefully that's one of the first lessons you learned. That's not a smart thing to do, right? Taking that kind of idiosyncratic levered position is a really dangerous thing to do, and we shouldn't be surprised that the recovery now has been painfully slow, and that we have to avoid this kind of vicious cycle of just having artificial consumption fueled by easy credit. Spain and Ireland are learning the exact same lesson. If you look at Spain, it's pretty remarkable. If you line up Spain and California like the Central Valley, it's basically the exact same pictures. I mean, it's the nice thing about being an economist and sometimes not paying too much attention to the labels. You see, I could look at the Spanish picture and say, that looks like the Central Valley in California. It's exactly the same phenomenon going on there. So whatever the shape is going to be of the recovery, let's hope it's based more on kind of fundamental improvements in income and permanent income of households not artificial debt-fueled household spending. So it's kind of a sobering note to leave you on, but hopefully we can, have a robust recovery that does not rely on housing to fuel kind of household spending. Thanks a lot.